Hello guys, I hope you all are doing well. I am Vishal Kumar and today we will learn about futures. So futures are the part of a derivative contracts which is basically an instrument for hedging. So futures are the financial contracts in which two parties agrees to buy or sell a specific asset at a predetermined price or a pre-decided price on a future date. So basically futures is a hedging instrument in which a party buys or sell a specific asset at a pre-decided price or a predetermined price. Means that the price is pre-decided and the date is also pre-decided, which is a future date. So in which case we buy the future and sell the futures. So now we will know this. So when we think that the specific asset or asset class will go upward or will be a bullish in future, so we will buy the future. We will do long the future. We will long the future. So in the finance field we tell buy as long and sell as short. So similarly it's opposite, like when our view is that any asset will go down or will be and there will be a bearish view, so we will sell the futures in that case. If our view is bearish and if we think that the asset will go down, so we will sell the futures. Okay, then in futures there are some more concepts like initial margin, variation margin, or mark to market margin, or maintenance margin. So what is initial margin? So in futures basically what we buy. So in futures we get very high leverage, that if we are going to buy a specific asset class, like if we are going to buy 10 lakh quantity of gold futures, so we have to only give 10 to 15% of that amount if we have to go in to and buy in the real market or to buy the real gold. Like if to buy the real gold for 1 kilo of gold we have to currently pay above 1 crore rupees. But in if we take the 1 kilo gold futures, we have to only pay only 10 to 15% and we will get the profit of all the 1 kilo gold. So in this case the broker or exchange demands the initial margin, that is the 10 to 15% that I have told you. So that is the initial margin. Like if gold is trading at 1 crore, so the 10 to 15% is like 15 lakh or 10 lakhs. So we have to only pay 15 lakhs or 10 lakhs and we will take the profit or loss of full 1 kilo gold. Like, so this is initial margin. And what is variation margin or mark to market margin? Like in futures or in derivatives there is settlement in daily, in our, like when we take futures, so there will be daily settlement. Like if there is profit, so it will be added to our portfolio or our portfolio value, and if there is a loss, so it will be deducted from our portfolio value. So that is mark to market or variation margin. Then what is maintenance margin? So if our portfolio value goes below the initial margin that we have paid, that 10 to 15% of gold which I have talked earlier. So if our portfolio value goes down from initial margin, then we have to then top up our portfolio to the that initial margin level. So that so after so so doing top upping our portfolio to that level, so this top upping is known as maintenance margin. So that we pay is known as maintenance margin to make our portfolio to reach our portfolio at again at the initial margin level. And if we not do so, then exchange will make a fine and will seize the full portfolio value. So this is futures. Thank you.